What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Happy Friday, everybody. I hope you are well out there, and this week's crazy news cycle is not messing with you. But yeah, it's Friday, so we're gonna do a free form Friday. I thought I just found a bunch of I don't know, random news items, random tweets, and we're gonna go through it. And then after I do the live stream portion on YouTube and Twitter and Twitch and that, I'm going to leave the mic open on Telegram and take a few comments or questions or talk about whatever you guys want to talk about. So what you're seeing right here is the website, bitcoinandmarkets.com. Put out the podcast version of FedWatch this morning with Bitcoin Magazine. Actually, I don't know if they have put it up on their feed yet, but I've done the write-up and I've put out my post about it. So you can find that on bitcoinandmarkets.com. You can sign up for the free weekly newsletter there. It comes out every Monday, and you can also support the show on bitcoinandmarkets.com by becoming a paid member. This week, I did not do a Market Pro. That's my premium content over there on the website because I got behind the eight ball. And I'm trying to put out some more content for the podcast and all of that stuff. Plus, I am moving a lot of older content onto this website. So anyway, I got a little bit behind on my schedule, as I guess always per usual for me. But I will be getting a Market Pro out maybe this weekend. Some of the sporting seasons are starting to wrap up for my kids, so I'm going to have more time on the weekends and things like that. But stay tuned. Okay, so let's go right into the charts. The Bitcoin price, 29,500. Nice little green candle this morning so far. Pushing up into that resistance area. I did have this drawn out. I don't know why I deleted this line, but I was watching this formation, and I'll have to share that again with Telegram here. And it looks like we might be breaking this to the upside, which is kind of crazy because of the bearish sentiment out there. You know, everybody and their mother thinks that we're going into recession and that there's going to be some sort of liquidity event. I mean, I kind of think there's going to be some event that makes the Fed pivot, but are we going to have a massive sell-off in the markets? I think it's still less likely than most people think. Powell yesterday, or when I was reacting to Powell yesterday on FedWatch, he said that his main base case was that we wouldn't go into a technical recession this year. And yes, that's Powell. Okay. He's talking his book a little bit because he doesn't want to be blamed for anything, blamed for not seeing stuff, I guess. But he has some of the most information in the world, and he's one of the most capable people in the world. And whether you think he's a liar or he's somewhat an honest broker, I tend to lean onto the side that he is mostly honest, like 80% honest with 20% manipulation in there. And that's what we kind of got into that yesterday on the FedWatch live stream. Because, I mean, he's better than Yellen, definitely. And we're going to talk about Yellen here in a minute. But he's definitely better than Yellen. And he's saying that he doesn't think there's going to be a recession. So we'll see. I don't know. I kind of trust, say, Powell more, or at least I think he has more information than most of these macro people out there that have been calling for a recession. And another thing too, that these people like Peter Schiff that constantly are calling for, the next disaster. They're going to be right eventually. That's for sure. But are they right now? I don't know. All of my analysis is saying that most likely not, that the rest of the year should be up for Bitcoin and up for the stock market and down for interest rates. and sideways or up for the dollar. So that's what my analysis is saying. And so far, it has been correct. I'm one of the lone voices out there, especially in Bitcoin, that has been talking about oil. Let's bring up the oil chart. That has been talking about how oil is going to continue to go lower. I remember having Luke Gromen on FedWatch, interviewing him, and I think it was like March, maybe it was March 9th or 10th, right near the top back then in 2022. And he's saying, oh, we're going to $300 a barrel, or 200, I think he said 250 or something. And I'm like, well, what if the top is in right now? Then that was exactly the top. And it's been going down. So all of these pundits out there that are calling for a recession are the same pundits that were calling for $200 a barrel oil. And they're the ones that were calling for $10,000 gold for 2 decades now. They will be right eventually, but not today. And I don't think this year. But okay, so that was oil and Bitcoin. Let's take a look at the 10-year. And Point said that there is a death cross coming. Look at that. Very interesting. Let me clear up some of these other. I'll hide these. All right. So yes, very, very interesting. I'll share this with Telegram. And wow, look at that. Right, pretty much crossing today, right in my happy place that I've been talking about for the 10-year for how long now? I think I started using that silly term back at the beginning of the year. But it stayed pretty much in this zone with a slight bias to the downside, you can see. Ever so slight, because we didn't make a new high here. Let me make my arrow bigger. We didn't make a new high here, and the bias has definitely been to the downside, but overall, this gray box happy place has been decent. Remember, most people think on the 10-year, on interest rates in general, that well, we'll get into this on the I have a Tom Luongo tweet here in a minute to go over, but most people think that rates going up is telling us that demand is going down because the economy is bad, and rates going down is a signal that the economy is good because it's stimulus to the economy when rates go down. But that's the exact opposite. Okay, rates go down as liquidity dries up, as there is stress in the system, and as money is tight, credit is tight. So anyway, I don't expect this to fall out of bed. If my thesis is correct, we should see something similar to, let me find the path tool. I mean, we might see something like this. I don't know. That would take us out to the end of the year, but it's not going to be, like this, down, 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 down. Put that in red. That's not going to happen. And I'll share that with Telegram. For many reasons. If you guys are new to the show and you're watching this live, I mean, I've been talking about this for a long time. You can see this gray box goes back a long time. But it's very interesting that we're getting a death cross here. So that tells me that not necessarily that it's going to fall off a cliff, but that there's structural resistance above these rates right now. And most likely, we're not going to see a reacceleration of rates to the upside. See, people don't get that. If we have inflation higher for longer, what that means is the 10-year has to go up. Rates have to go up because credit will be being printed. Credit will be loose. That's the only way you can have rates going higher. But we don't see that here. We see a death cross. really close to the price too. A lot of times when you have a death cross or a golden cross and it's far from the price, so the spread between the actual cross and where the price is a big spread, it usually signals that it's a reversal, not necessarily in the direction of the cross. But in this case, the cross is happening very close to the price. And so this should be a reinforcing signal. So there's structural resistance above these yields, telling me that yields won't go up, which means that there won't be a lot of money printing. There won't be a lot of quote unquote inflation in prices. So, okay, so that's very interesting. And he also said the 2-year. Let's take a quick gander at the 2-year. And that's getting very close too, and very interesting on the 2-year. I will share that as well. Good pickup on that price there, or on the death crosses. Okay. Let's go back to the stock market. Let's take a look at the stock market. S&P 500. Keeping these moving averages on here for now. Big green candle on the day. All things considered. Staying above the 50-day. Both the 50-day and the 200-day now are upward sloping. Price has found support on the 50-day multiple times without touching it. So that's a pretty significant sign. That means there's a lot of bids above that 50-day moving average. There was too many bids to even get to the 50-day. So that tells me that support is quite strong right there. And we will see where this goes. It's almost a megaphone pattern, like a small megaphone with higher highs and slightly ever so lower lows. So I'll have to be watching that. But, this looks good. It doesn't look like it was not a higher or was not a lower close. That's an important aspect as well for yesterday compared to, what day was that? The 26th was a lower close than yesterday. And now we're rallying. I saw a tweet by Nicoletos on Twitter, and he was saying that this is the most hated rally in 25 years that he's been paying attention to the market. I agree with him. Anyway, we'll see what happens with that. And lastly, let's take a look at the dollar, because I talk about this a lot. We passed that bear or death cross in the dollar, and now we're trending downward. There's no strength here in the dollar, but there's not a ton of weakness. I mean, think about the narrative that we have lived through in the last 6 months. The narrative that we have lived through in the last 6 months for the dollar is extreme bearishness. I can't think of an equally bearish time in my life. I mean, there's always talk about new currencies, but the people were dogpiling. This was a dogpile on the dollar, and it makes me wonder too about who's behind pushing this de-dollarization derangement syndrome. The dollar is fairly stable here. There is a chance it will sell off a little bit, but it's showing some strength. And if you zoom out, like, why is the de-dollarization talk up here at over 100 on the DXY? Why wasn't there this de-dollarization talk dogpile back here when it was down at 89? Back in May of 2021, it was at 89. 13% lower than where it is today relative to these major currencies. It's only now that there's all this de-dollarization talk. And let me tell you why. Because the de-dollarization talk is a direct result of deflation, of deflationary pressure on the economy. People are certain, there's not enough dollars. Their economy is being wrecked by being on the dollar system because there's not enough dollars. So they're looking for a monetary alternative. It's the same story over and over again. The reason why we're having the de-dollarization talk at the top is what I'm saying, because of the deflationary pressure. We didn't have the de-dollarization talk at the bottom. Why? Because people are relatively happy with that. Other countries like it. I've said that if these economies were doing well on the dollar system, they wouldn't want to get rid of the dollar. The dollar system is making their economies bad through a deflationary pressure, which is why there's all this talk about de-dollarization. But even with this dog pile of this derangement syndrome, the dollar is still over 100. All right. So that's it for the charts. Let's go into some tweets here. And this is the chart by Hodl Magoo. It's an exponential chart. Looks like there's some Elliott wave counting on here. I'm not an Elliott wave person, but I did share this with Telegram, and this would match my general thesis here. So when I posted it on Telegram, for those listening to the live stream that weren't or aren't in the Telegram, this is what I said. I said that I really like this chart, not just because it's showing, it's a Bulltard chart, but because it embodies the proper dynamics of how I believe markets work. Okay, there's going to be FOMO. There's going to be unexpected moves. Like nobody can think that Bitcoin can get to 50,000 within a week or two. And that's one reason why it probably will, or maybe not in a week or two, but sooner than people think it'll be at 50,000 again. So this chart embodies the unexpected dynamics and FOMO in the market. It also shows a repricing event that will pick up speed as you go. Markets have these exponential moves like this because of FOMO and because of just the natural dynamics. So I really like this chart. What else do I say? Okay, so it'll be a repricing event that psychologically won't give enough time for no coiners to get into Bitcoin. And bears will have to pay the price. So I don't know if I'm just way too bullish and believe in some sort of divine justice out there, but this makes sense to me. And where does this have it going? He has this blue he has this blue circle right around my target, which is very interesting. And it is in, let's see, July, August. Wow. Yeah, pretty much what I've been saying. That this is some of the predictions I've been making on the Market Pro is right at this blue dot, the next extension on Hodl Magoo's chart here. Very interesting. Okay, let's go to the next one. So this is Sam Callahan, and he tweets that MicroStrategy is integrating Lightning rewards internally with Salesforce, Zoom, Adobe, and MoveSpring to incentivize people to educate themselves, share their knowledge, hit their fitness goals, and more. And I guess this came out of the MicroStrategy conference that's going on down here in, where is it? Orlando? I believe it's in Orlando. I don't know what to think about this because we don't need the Lightning Network for this type of stuff. I mean, is this going to be self-custody and somehow it's just integrated with Lightning? It's not like a custodied solution, because if it is, then we don't need Lightning for that. It's kind of gamifying these things, and you would think that this would already be happening if this was like a legitimate use. But overall, I do like this just as a publicity stunt for Bitcoin. I wonder what you guys think. So when I get, when I'm done with the live stream, I'll stick around on Telegram, and I want to hear what you guys think about that. Okay, last but not least is this Tom Luongo tweet. And I like Tom Luongo. I appreciate his his style. I appreciate his content. I appreciate with the dots that he connects. But I think he's wrong here. Okay, so he says, why do you think Secretary Yellen is buying the long end of the yield curve? It's not to improve liquidity conditions. And what he's speaking of is, I don't know if they're actively doing this right now, to be honest with you, but the back in last fall, I think October, November time, Janet Yellen floated this idea of buying long dated treasuries as a way to improve liquidity conditions, like he's saying here. And Tom Luongo is pretty much saying that's a conspiracy theory, that there is no real, this is yield curve control. This is not trying to improve liquidity. But I've read a lot of papers that the Fed has put out over the years, gone back and looked at liquidity conditions during like the repo rumble. And the papers are talking about their long dated treasuries lose bids. They go bidless. The entire market for like the 10-year treasury is gone overnight. That's what happened in the repo rumble. There was only a market for like 1 month to 3 month treasuries. So that's what I think Janet Yellen is worried about. They're trying to create an artificial market for treasuries by being some buyer of last resort of these treasuries to stop something like the repo rumble or the great financial crisis from even getting going. Because in the great financial crisis, there was also the market for treasuries just completely dried up, and there were no bids in the repo market. So that's a big concern, and they don't know how to address it. This is how I think they were looking to address it. You have to, he's thinking that okay, let me just continue with this tweet. It's to suppress US yields to keep the EU sovereign debt afloat. 85% of the ECB's balance sheet is subject to a rate shock. Neither gold nor Bitcoin can fix this. Only going back to zero bound can. Well, that's where we're headed. Okay, we're headed back to the zero bound, even if the Fed continues to raise rates. So let's go back to the charts here real quick. And we will go to the 4-week. Take it off a log. Wow, what a big move in the 4-week here. But then I'll put on the Fed funds. And man, did it recover. I'm going to actually post this on Telegram. And this did recover very quickly. But look at this. This is not telling me that the Fed is in control. Dip down, it's 100 basis points, 150 basis points below the Fed funds target range. How is that possible on the 4-week if the Fed is in control? The Fed uses manipulation. They do not use mechanical means they try to use mechanical means. That's what the reverse repo rate is. That's what the interest on excess reserves is. They try to use these mechanical levers to keep the interest rates where they want them, but they're not in control. Look at that. How is that possible? So going back to Tom Luongo's tweet, I agree that Yellen is a Davos crowd member, and there is some freaking out about the situation in Europe. I saw the German PMI data. It just is atrocious. It's like the lowest other than COVID in the last, 25 years or something. Their orders for their factory orders are falling off a cliff. It looks really, really bad over there in Europe, way worse than the United States. So I agree with him that Yellen has this Davos mentality, but no, I don't think they're buying yield or they're doing yield curve control to help Europe. Okay. I don't think that's what's happening in a crisis. See, Tom's thinking that in a crisis, yield should spike. But in a crisis, yields actually drop because of the flight to safety. Now, actually, I just thought of something going back to this chart here again. Debt ceiling. I think this is the debt ceiling because that's going to be coming up next month. So, first, the rates plummeted because of a flight to safety. Now there's a sell off because they're worried about the debt ceiling. I'm pretty sure that's what's going on here. That's very interesting. But in a crisis, rates should fall naturally. So Tom has this wrong. Crisis will cause rates to fall and go back to the zero bound. That's what we're about to see. So anyway, guys, that is going to be it for this Freeform Friday. I appreciate you joining me. My name is Ansel Lindner. Check out bitcoinandmarkets.com for all of my content. Sign up for the free weekly newsletter. Check me here Monday, Wednesday, Fridays around midday for my live streams. And that's going to do it. Hope you have a great weekend. I'll see you next time. Bye.